My objective is to make you financially independent and help you make the right money move. Well, I'm on track to make my first $1 million soon. Let me share the knowledge that changed my life. I am a true follower of Warren Buffett. Over time, Warren Buffett acquired valuable lessons that can help you become richer, perhaps faster than many. Here are the top 13 tips for investing and building wealth fast in 2024. Before we start, please hit the like and subscribe button to get more such content that helps you grow. Have a long-term perspective. Warren Buffett has always emphasized the importance of having a long-term perspective when it comes to investing. This means thinking about your investments for tomorrow and many years to come. And you know what? Buffett walks the talk. Seeing as he's been buying stocks since he was 11, he's now over 90 years old. Why does it matter? Well, having a long-term perspective means you don't get worried when the stock market goes down. Instead, you see it as an opportunity to buy lower-priced stocks. Take advantage of market declines. Warren Buffett has revealed that he likes it when stocks go down because he's a net buyer. Speaking of a net buyer, in the context of investing, means that an individual is actively purchasing more assets or securities, for example, stocks, than they are selling. When Warren Buffett says that he's a net buyer of stocks, he's emphasizing that despite short-term fluctuations in the stock market, he sees declining prices as an opportunity to buy more stocks for the long term. Buffett points out that this perspective is particularly relevant for investors under 55. Why? Well, individuals in this age group are still in the accumulation phase of their wealth-building journey, and a declining market presents a favorable environment for purchasing stocks that may appreciate over the long term. Well, the same has helped me to grow. I bought 250 Tesla stocks at $103 in Jan 23 and sold at $292, making a whopping $47,000 in just a matter of 7 months. Leverage the power of compounding. Another valuable insight from Warren Buffett's investment philosophy is the emphasis on leveraging the power of compounding. And just to get us on the same page, compounding is like planting a seed that grows into a mighty tree. Initially, the tree seems small, but with time, it branches out and sprouts new leaves. Each leaf represents the growth from the previous one. Compounding, the overall size and strength of the tree. Similarly, in finance, compounding involves reinvesting earnings to generate additional earnings, creating a snowball effect. The initial investment, like the seed, multiplies over time and the accumulated returns becomes the branches and leaves of financial success. As Buffett has been investing for numerous years, he highlights the significance of letting your money grow not only on the initial investment, but also on the returns generated by that investment. Understanding the impact of interest rates. Warren Buffett's investing advice for 2024 extends to understanding the impacts of interest rates. Think of interest rates as the force that guides how money moves in the economy. When interest rates are low, it's like an invitation for people and businesses to access money easily. This leads to more spending, more profits, and overall economic growth. Now think of it as the opposite when the interest rate goes up. Borrowing money becomes more expensive, and this affects both businesses and individuals. Businesses may find it harder to repay loans, and people may have less money to spend. Warren Buffett's point is simple but powerful. Changes in interest rates can have a big impact on the stock market. If interest rates are going up, stock might face some challenges. Knowing this helps you make smarter decisions about your investments based on what's happening in the economy. Be fearful when others are greedy, and greedy when others are fearful. This simple yet powerful advice is a guide for understanding how people feel about the stock market. When many people are excited in buying stocks because they think they'll make lots of money, Buffett suggests it might be a good time to be careful. On the other side, when there's a lot of fear in the market and people are selling their stocks because they're worried about losing money, Buffett's advice is to think differently. This is when he says it's okay to be a bit greedy. Being fearful when others are greedy might mean selling a bit when the market is super optimistic. Being greedy when others are fearful could mean actively looking for suitable investments when everyone else is a bit scared. Avoid trying to predict the market. Buffett believes that predicting exactly how the stock market will move, especially in short term, is not the only challenge, but often leads to mistakes. Even experts, including Buffett himself, finds it difficult to forecast market fluctuations accurately. After all, the market is influenced by various factors, many of which are unpredictable. such as economic indicators, geopolitical events, technological advancements, and shifts in customer behavior. Buffett's advice suggests that instead of trying to time the market perfectly, you should concentrate on the fundamentals of your investments and the long-term potential. That means focusing on the quality of the companies you invest in, their long-term growth potential, and the overall stability of your investment portfolio. Embrace bad news. Embracing bad news, as recommended by Warren Buffett, is a counterintuitive yet valuable approach for several reasons. Firstly, bad news often presents opportunities for insightful investors. Market reactions to negative developments may create undervalued assets, offering a chance to buy low before a potential rebound. Secondly, facing bad news directly fosters a realistic understanding of risks, enabling more informed decision-making. Thirdly, rather than succumbing to fear, embracing bad news with a strategic mindset allows for calculated responses and the potential to capitalize on the long-term gains. Invest in high-quality businesses. Investing in high-quality business is a strategy endorsed by Warren Buffett himself for several compelling reasons. First and foremost, such businesses often have a history of stability, reliable earnings, and strong management. The stability can provide a buffer during economic downturns, making them more resilient investments. Second, high-quality businesses are likely to possess enduring competitive advantages or economic moats that protect them from competitors. Third, these businesses often demonstrate a track record of prudent capital allocation and shareholder-friendly practices, contributing to long-term value creation. By prioritizing high-quality businesses, investors align with Buffett's principles of seeking enduring value and minimizing risks associated with market volatility. Improve your earning power. Boosting your earning power is pivotal for various reasons, and it aligns with sound financial principles advocated by experts like Warren Buffett. First, an increased earning capacity provides greater financial stability, allowing you to meet your current needs and build a more secure future. Moreover, it enhances your ability to save and invest, exhilarating wealth accumulation. Third, an improved earning power opens up opportunities for strategic investments supporting long-term financial goals. Additionally, it provides a buffer against economic uncertainties and unexpected expenses. Avoid obsessively checking your portfolio. Buffett suggests resisting the urge to constantly monitor your investment portfolio, especially during challenging economic times. You ask why? First, the financial market is inherently unpredictable, and frequent checks may lead to impulsive decisions based on short-term fluctuations. Second, constant monitoring can induce unnecessary stress and anxiety, potentially hindering your overall well-being. Third, successful investing often requires a long-term perspective, and frequent updates may distract you from your strategic goals. Finally, the temptation to react to every minor change can lead to excessive trading, incurring unnecessary transaction costs. Instead, focus on a well-defined investment strategy, periodically review your portfolio, and avoid the stress associated with obsessive monitoring. Ensure financial preparedness. Before diving into investing, Warren Buffett underscores the significance of financial preparedness. This entails establishing a robust emergency fund that can cover 3 to 6 months of living expenses. This financial cushion serves as a safety net, providing a buffer against unexpected expenses or income disruptions. By ensuring this preparedness, investors can navigate market uncertainties with greater confidence, knowing they have a financial foundation to fall back on. It aligns with Buffett's philosophy of being ready for any economic climate, allowing you to approach investing with a sense of security and resilience in the face of unforeseen challenges. Don't let fear control your decisions. Buffett advises against letting fear dictate your investment choices for several reasons. First, fear often leads to impulsive actions, causing you to deviate from a well-thought-out investment strategy. Second, it can result in missed opportunities, as decisions driven by fear may prevent you from capitalizing on long-term growth prospects. Third, succumbing to fear increases the likelihood of making emotional and irrational choices that may not align with your financial goals. Understanding the impact of financial inflation. Understanding the impact of financial inflation is crucial for financial decision-making. Inflation erodes the purchasing power of money over time, diminishing the value of savings and investments. Without an awareness of inflation's effects, you may underestimate the funds needed for future expenses such as education or retirement. You also need to consider inflation when assessing returns. Otherwise, apparent gains may be eroded by rising prices. Warren Buffett emphasizes this understanding because it enables informed planning, ensuring that financial strategies account for the real impact of inflation and helping individuals and investors make more realistic and long-term financial decisions. The road to wealth is a journey, and choosing the right path is crucial. I made my first $100,000 from zero savings, and with discipline, success is just a matter of time. Are you ready to apply Warren Buffett's wealth-building tips and embark on your journey to financial success in 2024? Share your thoughts in the comments below. If you found this video valuable, don't forget to subscribe and explore our other content for more insights.